Thank you for that introduction, Jan, and it is indeed a pleasure to be here in Bratislava today. I want to thank the Hyatt Foundation and the other sponsors, first of all, for inviting me, and also their very nice hospitality since I've been here. I've had a chance to visit the city and go around to different historical sites and monuments, and Bratislava is a beautiful city with a very rich history, and I've been able to share in some of that in the time I've been here, so I'm very appreciative of that, very appreciative of the opportunity to be here, so it's certainly a pleasure. We're going to talk about, I'm not going to spend a lot of time on the 2008 crisis, because I think we're all very familiar with that. We've had many books written about it. We understand some of the causes of it, some of the damage that has been done, what's happened since the crisis. I want to spend more time really thinking about the future, sort of where are we now and where are we going in the international monetary system. I'll talk a lot about the dollar, but not just the dollar, also global currencies in general and the international monetary system in general. So we'll try to be we'll have some history, some science, some economics, and some forward-looking analysis. So a couple different parts of the presentation. I'll spend a little less than an hour talking, and then we'll have time for questions and answers. So I look forward to that. I always enjoy the question and answer part because it's a good opportunity for me to learn something and find out what people are thinking, what really concerns them. So I look forward to that as well. So with that said, we'll jump in. Before I get into a lot of economics, I want to talk a little bit about the national security implications of the role of the dollar in the international monetary system. Because today, the dollar is not just an economic concept, it's also a strategic concept. I tell U.S. government officials and audiences such as this, there is no such thing as a strong national security without a strong currency. If you have a weak currency, you cannot be a global power of the type that the United States has been, at least since the end of the Second World War. And if you go back and look at prior global powers, whether it's the British Empire or go all the way back to the Roman Empire, during their periods of greatest strength, they had monetary stability, either a gold-backed coin or gold currency or very strong currency from the Bank of England, and you can almost trace the decline of their power contemporaneous with the decline of their currency. So this should be a concern for the United States. This is getting some recognition in military and intelligence circles in the United States. It's not just limited to the Treasury or the equivalent of our Ministry of Finance or the Federal Reserve, our central bank. It's getting attention among military, intelligence, and diplomatic units as well. And a few years ago, and I talk about this in my book, in 2009, the Pentagon did the first ever financial war game. Now, the Pentagon, our Department of Defense, does war games all the time. They've done these for decades. There's nothing new about a war game. But this was the first one that was a financial war game. So the rules were you could not use any what we call kinetic weapons, and nothing that would shoot or explode, no bombs or missiles or planes or submarines, etc. You could only use financial weapons, so stocks, bonds, commodities, currencies, and derivatives. And I was invited to help design the war game. The Pentagon did not need any help from me on war games in general, but they did need help on capital markets because that was a new area for them. So I was invited in as a capital markets expert, and it was fun to design the game. I don't know if you're familiar with a popular board game. I think it's pretty international, called Risk. So I call this Risk for adults. We were adults, but we got to play a very interesting game. And then once we had to decide, what the teams would be, how long would it be, who would be invited to play, what the scenarios would be, and so forth. And then I got to actually participate in the game. We did this at a place called the Applied Physics Laboratory, which is a top secret weapons laboratory about 20 miles outside of Washington, D.C. The people who were there included people from the intelligence community and the defense community, but also people from the Federal Reserve and the Treasury and outside experts, people from think tanks and universities. And I was tried to persuade the sponsors that we should invite some actual bankers from Wall Street, because who knows more about manipulating markets than people from Wall Street. And I thought that would make the game a little bit more realistic, and we were able to invite a few money managers to join us. We played this over 2 days. When I was done, I went home and I said to my wife, I have good news and bad news. The good news is my team won. The bad news is I played China. It's all described in the book. I don't want to spend a lot more time on it. I just want to make a basic point. I was briefing at the Pentagon recently, and I said, the time will come when a U.S. destroyer will pull up at a fuel depot in Singapore, and you'll ask the person at the dock to fill up the vessel with fuel, and they'll say, that's fine, we want you to pay us in SDRs, IMF special drawing rights. And I said, for the first time, the U.S. will have a very expensive forward deployed military that you have to pay for in a currency that you don't print. And that really sank in. They said, you're right, if we evolve into that world, it's a very different world from the U.S. perspective. So I'll leave it at that, but I just make the point that there's more to the dollar analysis and the monetary analysis than just economics, which we're all concerned with, but it does have a very important national strategic aspect. And I think that as China and Russia and other countries, Iran, perhaps others, try to compete with the United States, or in perhaps an adversarial relationship with the United States, they will not seek power through military means. The U.S. in the traditional military is still very dominant, but they will seek it in what we call asymmetric warfare. That can involve various means, certainly weapons of mass destruction, but also cyber warfare, and I think in the future financial warfare. So it's a very important subject from that perspective, and we do talk about this in the book. So let's get back to economics, and a lot of what I want to describe has to do with what I call currency wars. And I should take a minute to give a definition of a currency war, because some people say, well, wait a second, we've had floating exchange rates since the 1970s. There's nothing new about floating exchange rates, and we have periodic currency crises, and we see currencies going down against the dollar and up against the dollar. So what's a currency war? What's different about that? What's new about it? Well, what's new is that, yes, currencies do fluctuate. We do have floating exchange rates, and there are perfectly good fundamental economic reasons for exchange rates to change. These would have to do with changes in comparative advantage, trade advantage. They could be demographic, they could be technological, it could involve other structural policy changes, it could involve natural resource discoveries. So there are good reasons for currencies to change in value as comparative advantage shifts. That's not a currency war. A currency war is when a country intentionally and purposely, as a matter of policy, seeks to cheapen its currency for the sole purpose of stealing trading advantage from its neighbors. In other words, it's not the result of fundamental changes in economic factors, it's a result of manipulation and policy for the purpose of getting trading advantage from your partners, or some economic advantage from your partners. We don't have currency wars all the time. They tend to arise in periods when there's insufficient growth in the world. When growth is very strong, take a major country like the United States, in a period of strong growth, some country somewhere might try to cheapen its currency against the dollar to get some trading advantage, and the U.S. doesn't care. We say, well, fine, we understand you're doing that, but who cares? We have good growth, and the world has good growth, and it's not really a problem for us. Currency wars arise when there's not enough growth to go around, usually caused by too much debt. The debt diminishes growth, then you don't have enough growth, and countries are tempted to, in effect, steal growth from their trading partners through the currency wars, and that's when currency wars arise. We're not in them all the time, but when we are in them, they tend to last for a very long period of time. They can last for 5 or 10 or 15 years. One thing a lot of people say to me is, my book came out in 2011, I started writing it in 2010, and people say, well, gee, it's 2013, we're in a currency war, how did you know 3 years ago that we would be in this currency war? And my answer is, well, first of all, the currency war started in 2010, so we had some idea then. But because they last so long, I'm not surprised. I think we'll be talking about currency wars in 2014. I think I could come back 2 years from now, and we would still be talking about the subject because they go on for a very long period of time. So what we're describing is not just of historic or even contemporary interest. I think it's a very good guide to what will be happening in the years ahead. So that's one of the reasons I put some importance on it. I mentioned that we've had currency wars before. I'd like to talk about a couple in particular, what I call Currency War I, which lasted from 1921 to 1936. Now you'll see that these dates are somewhat contemporaneous with what we in the U.S. call the Great Depression, but not exactly. The Great Depression is conventionally dated from about 1929 to 1930. Reichsmark, a $1 trillion Reichsmark that is only printed on one side. They started printing the money on one side and leaving the other side blank to save ink. That's how extreme it was. And there were stories of, in Berlin in those days, you would go out to dinner and you would pay your dinner bill at the beginning of dinner because it would be 3 times more expensive at the end of dinner, even a couple of hours later. These stories are all true, by the way. And then a loaf of bread would be a trillion Reichsmarks, and then the next day it would be 2 trillion Reichsmarks. Well, there came a time when the exchange rate didn't matter anymore. The money actually became completely worthless. It didn't even function as money. There was no value. It became litter and was swept down the sewers. What happened next was very interesting, however, which is over a period of about 6 or 8 months, Germany launched a gold-backed currency. First they had a new currency backed by mortgages, and then finally they got some loans from the United States. They were able to import some equipment to begin to export. They began to have some export earnings. They used the money to acquire gold, and they had a new gold-backed currency. From 1924 to 1929, Germany was the fastest growing major economy in the world, major industrial economy in the world. Germany had all the factory inputs they needed. They had an educated workforce. They had a transportation network. They had some coal and energy. They had factories. They had technology. They had everything they needed. What they did not have was a strong currency. And once they got the strong currency in 1924, the economy grew very strongly for the next 5 years. So it shows the importance of a currency. If people lack confidence in it, the economy will be dysfunctional, and if they have confidence in it, then the economy can be very productive. So then let's go forward to 1925. Now the dilemma is, prior to World War I, from 1870 to 1914 approximately, the world had been on a gold standard, a very pure, what's called the classical gold standard, where your currency was fixed to an amount of gold, and all the major currencies in the world, and most of them were fixed to an amount of gold, which meant that the cross rates were fixed. Once you have two currencies defined as an amount of gold, then they obviously have a fixed relationship to each other. So a world of fixed exchange rates and a gold standard that had worked very well. That was a period of prosperity, low inflation, actually deflation during part of it, great technological advances, steamships, radios, airplanes, etc., and international finance. It was really the first stage of globalization. I like to say that from 1989 to today is really the second age of globalization, but really from 1870 to 1914 was the first stage of globalization. Well, that ended abruptly, of course, in 1914 with the beginning of World War I. Countries very quickly abandoned the gold standard because they needed to print money to fight the war. That's an existential crisis, so one can understand that. But by the 1920s, countries wanted to go back to the gold standard. They knew that had worked fairly well. But it raised the question, at what exchange rate would you go back to the gold standard? What would the price of gold be in your currency when you went back to the gold standard? Now, the problem was that they knew the price prior to World War I, but they had doubled the money supply. They had printed money in order to fight the war. So now when you printed that much money, so you had an old parity here, you've now doubled the money supply, and you want to go back to a parity with gold. Well, you really have two choices. You can double the price of gold, which means really cutting your currency in half. It's the same thing. Or if you want to go back to the old parity, you have to cut the money supply in half. Well, France thought about that and they said, well, that's easy. We're just going to cut the value of the currency in half. So in other words, they doubled the price of gold in French francs, which meant a 50% devaluation of the French franc. This was highly inflationary in France. There was a movie a couple years ago, Woody Allen movie called Midnight in Paris, I think very popular around the world, and it showed American artists, singers and writers, etc. in France, in Paris in 1925, living a very extravagant lifestyle. Well, that was true. If you were an American and you had dollars, because of the devaluation of the French franc, you could go to Paris and live like a king, so to speak. So that inflation broke out in Paris. Well, then at that point, but England had the same decision. England had to decide where to go back to gold. Now, they made a different choice. Winston Churchill was the Chancellor of the Exchequer, and he felt duty-bound or honor-bound to go back to gold at the pre-World War I level, at the exchange rate for sterling to gold that had existed in 1914. So he did that, but the problem, of course, and Winston Churchill was a great war leader, but he was a very poor economist. And to do that, they had to cut the money supply in half to reestablish the old parity. That was extremely deflationary. England was in a depression 4 years ahead of the rest of the world. England was in a depression in 1926. Most of the rest of the world didn't go into depression until 1929, 1930. England had the most overvalued currency in the world. This meant that France and Belgium, Italy, and others had a trading advantage in terms of a cheaper currency. They were getting more tourism, more exports, etc. England's economy was suffering. Finally, by 1931, England had enough. There was a banking crisis. The banks in England collapsed. And interesting, you know, the 1931 banking crisis has been closely studied, but in the hundreds, if not thousands, of books written about it. But my book was the first one that talked about the 1931 crisis from the perspective of 2008, because I got to write my book after the 2008 crisis. And the similarities are striking. I mean, what happened with Lehman Brothers failing, and our firm Bear Stearns failing, and Morgan Stanley would have failed, and Goldman Sachs would have failed, but for bailouts from the Federal Reserve. That sequence was exactly what was happening in 1931. All the major English banks would have failed, but for the fact that the Bank of England abandoned the gold standard and devalued sterling against gold, something that they should have done in 1925, but they had committed that very major mistake. So now we have the sequence where Germany devalues in 1921, France devalues in 1925, England devalues in 1931. So who's left? The United States. So now the United States has the most overvalued currency in the world. And by 1933, we had suffered through 4 years of extreme depression and deflation. Prices dropped over 25% in the United States between 1927 and 1933. So finally, the U.S. joined the club. We devalued the dollar against gold in 1933. Gold was about $20 an ounce in the beginning of 1933, and by 1934 it was $35 an ounce. So this is a more than 50%, about a 40% devaluation of the dollar measured in terms of units of gold. But our President Franklin Roosevelt, did a very clever thing. He knew that he wanted to devalue against gold. He knew he was going to do that. So he issued an order. He confiscated all the gold in the United States. It became illegal for U.S. citizens to own gold. It was actually a felony. You could be arrested and put in jail for 5 years. Owning gold was like having, you know, drugs or contraband. You could be put in jail. And he bought up all the gold at $20 an ounce. So you had to go down to the Treasury or post office, hand in your gold. You got $20 an ounce of paper money, and then they very promptly revalued gold to $35 an ounce. And they did that because they wanted the government to capture the profit. They did not want gold investors to profit from the devaluation of the dollar. They wanted the government to capture the profit. So that's what they did. The purpose of doing this, by the way, was not just to, you know, reward gold holders or to make a profit on gold. The purpose of devaluing the dollar against gold was to cause inflation, because nothing happens in isolation. If the price of gold goes from $20 an ounce to $35 an ounce, which it did, the idea is the price of everything else will go up too. So oil, cotton, wheat, steel, etc. And that's why President Roosevelt did it. He wanted to cause a generalized inflation, and it actually worked. The U.S. Grew in 1933, 1934, 1935. We got out of deflation. We caused some inflation. The stock market rallied. Unemployment came down. That was a period of pretty good growth. Now, we went back into a second recession in 1937 that was quite severe, and that prolonged the Great Depression. But this particular trick, if you will, worked, although it came at the expense of private gold investors, because they were the ones who had their property, in effect, confiscated. So, and then in 1936, England and France devalued again. So you had this sequence, 1921 Germany, 1925 France, 1931 England, 1933 the United States, 1936 England and France again. This period of so-called beggar thy neighbor currency devaluations, and we all know what characterized that period. It was the Great Depression, industrial production collapsed, unemployment skyrocketed, the stock markets crashed. One of the worst periods of economic performance in world history. So that's sort of what you got for your currency war. Okay. So then we come ahead to what I call Currency War II, 1967 to 1987. This was another period when, now of course we're coming out of the Bretton Woods period. We're back on a gold standard starting in 1944, and gold is valued at $35 per ounce. The United States, U.S. citizens, it's still illegal to have gold, but the U.S. did give gold to its trading partners. So if you were France or Belgium or Germany or any trading partner with the United States, if you traded with the United States and you earned a surplus, so you had dollars, you could take your dollars and give them to the United States and get gold at $35 an ounce. And they did. In 1950, the United States had 20,000 tons of gold. By 1970, the U.S. had 9,000 tons of gold. So where did the 11,000 tons of gold go? Well, it went, 3,000 tons to Germany, 2,000 tons to France, 2,000 tons to Italy, 500 tons to the Netherlands, etc., around the world. So our trading partners earned a surplus in dollars, cashed it in, and got gold. By 1969, 1970, it was very clear that this system was unstable, that people were losing confidence in the dollar. People believed that the United States would not be able to maintain the dollar at $35 per ounce of gold. In fact, there was a private market where gold was selling for $42 an ounce. So what some of the U.S. trading partners were doing, they would cash in their dollars and get gold at $35 an ounce and turn around in the private market and sell it for $42 an ounce. It was a risk-free arbitrage. This was the so-called gold window. So finally, in August 1971, President Nixon shut the gold window and said, no more gold. From now on, if you trade with the United States and you make dollars, you can take the dollars, you can buy our stocks, you can buy bonds, you can buy real estate, buy anything you want, but you cannot have gold. And since then, the U.S. has maintained the gold that it had. We sold a little bit of gold in the 1970s. By 1980, the United States was down to about 8,000 tons of gold, and we've been there ever since. We've kept the 8,000 tons. So that was what I call Currency War II. Again, a period of disastrous economic performance. The United States expected that by devaluing the dollar against gold, we would promote U.S. exports, create U.S. jobs, expand the U.S. economy, etc. That did not happen. The opposite happened. We had 3 recessions back to back to back in 1974, 1979, 1980. The United States had 3 recessions. Our stock market crashed in 1974. We had borderline hyperinflation from 1977 to 1981. Cumulative inflation in the United States was 50%, 50. The dollar lost half its value in that brief 5-year period. The dollar came very close to collapse in 1979, and the question is, why didn't the dollar collapse? What saved the dollar? Well, the answer is just in a couple words: Paul Volcker and Ronald Reagan. Paul Volcker became chairman of the Federal Reserve. He decided to make the dollar valuable again. He raised interest rates to 19%. He said, If you own dollars, we're going to give you a return that's higher than inflation. We're going to crush inflation, give you a positive return. So he raised interest rates. President Reagan cut taxes, cut regulation, created a more positive business climate. So the combination of Reagan's tax and regulatory reforms and Volcker's new monetary policy rescued the dollar and created a period that we call sometimes king dollar or strong dollar, but it was really the sound dollar. Beginning in 1980, from 1980 to 2010, the world was not on a gold standard, but we were on a dollar standard. The United States said to the rest of the world, we're going to maintain a sound dollar, strong dollar. And you, our trading partners, can rely on that. If you want to accumulate dollars, they will be valuable. If you want to fix your currency to the dollar, we will maintain the value of the dollar. This continued through Republican and Democratic administrations. President Reagan, President Bush, President Clinton, both parties continued this policy, and it was very, very successful until 2010. 2010 was the beginning of what I call Currency War III, which we're in now. And in January 2010, President Obama, Ben Bernanke, Chairman of the Federal Reserve, Timothy Geithner, Secretary of the Treasury, together abandoned the sound dollar standard. They said, in effect, it is now the policy of the United States to cheapen the dollar. A lot of people think this relates to exports. You know, if you cheapen your currency, we can sell more Boeing aircraft or General Electric turbines, etc. That's not the real reason. That's not the reason the United States is cheapening the dollar. The reason the United States is cheapening the dollar is not to promote exports, it's to import inflation. Because the U.S. is a net importer. We import more than we export. And so if you cheapen the dollar, you have to pay more for all of your foreign goods, whether it's energy, Chinese manufactured goods, electronics, textiles from India, whatever it is that Americans buy, we have to pay more for it. And that is really the purpose of cheapening the dollar, is to import inflation. Same thing is true in Japan, by the way. Abenomics is best understood. People talk about it as helping exports by Sony or Toyota. Maybe it does a little bit, but the real purpose is to import inflation. These central banks are desperate to get inflation right now because they worry about deflation. We'll talk a little bit more about that. So we're in Currency War III now. I'd like to talk about what Ben Bernanke thinks of as his view of the currency wars. And Bernanke gave a speech not too long ago, and he urged a policy in which the U.S., the UK, Japan, and Europe would all engage in monetary ease at the same time. So I analogize it to the four countries holding hands and jumping out of an airplane together. And Bernanke's theory was that the problem with the 1930s, as I described, was sequential devaluations. You know, 1925, 1931, 1933, that the sequential devaluations were suboptimal and economically costly because nobody could rely on anything. There was no certainty. He said if we all print money at once, it's not a currency war, because if you're all printing money at once, the cross rates and the comparative advantage should be, in theory, unchanged. So you're getting the benefit of monetary ease without the cost of a currency war. And that's really an optimal outcome, and that's what the world should do. And he actually came up with a phrase. He said, this is not beggar thy neighbor, this is enrich thy neighbor. Those are Bernanke's exact words. There are a lot of things wrong with this. The first thing that's wrong is that Europe actually does not want to go along with this plan. The US, the UK, and Japan are absolutely doing this. All three central banks are printing as fast as they can. But the European Central Bank takes a different view. They will print money or engage in monetary ease in order to save the euro if they have to in distress, but not more. They will not print for the sole purpose of creating inflation. So they'll print some to save the euro, but they will not print more to create inflation. So Europe doesn't share the view of the United States that somehow inflation is a good thing. That's number one. But also, more to the point, what about the rest of the world? You know, it's fine to say US, UK, Japan, and Europe should participate in monetary ease, but what about everybody else? And this is where the BRICS come in and other emerging markets. They're the ones who are disadvantaged by this because their currencies are expected to appreciate, which of course hurts their exports. So they really have two choices. If you're China, for example, if you want to peg to the dollar and the US is printing money, you have to print your own money to maintain the peg, right? Because the dollars are going to China, and if you're a central bank and you want to maintain an exchange rate between Chinese yuan and dollars, you have to tell all the Chinese exporters, we will buy your dollars at a fixed rate. Well, if the US is printing money and the money is going to China, China has to print the money to buy the dollars. That means the inflation comes out in China. In other words, the inflation that you might expect in the United States actually gets exported to China through the exchange rate mechanism, through the desire of China to maintain a fixed rate to the dollar. That's choice number one. Choice number two, if you don't like inflation, and inflation is very destabilizing in China, choice number two is to let your currency appreciate, let your currency go up. In other words, don't maintain a fixed value. If you do that, you won't get the inflation, but you will hurt your exports, and that can hurt jobs. So U.S. trading partners are listening to this. They're saying, wait a second, you say choice number one is we get inflation, choice number two is we hurt exports. Why is this a good deal for us? Why should we go along with this? And Bernanke's answer is, well, choice number three is worse, which is we don't print and the U.S. economy collapses and we take you with us. So Bernanke's saying you have to take the first two bad choices because the last thing is the whole economy, the whole world will go into another stage of depression. It's a little bit self-serving, but the problem with Bernanke's theory is that it causes enormous distress in emerging markets. I just got back from South Africa recently. They don't know which way to turn. Their currency went from 8 rand to the dollar to almost 11 rand to the dollar. And then when the Fed chose not to taper, it went back down to 10. I mean, how can you run an economy? How can you have an interest rate policy? How can your exporters decide to invest when your currency is going like this? Not because they had any bad policy, but because the U.S. Policy is so uncertain. We don't have a gold standard. We don't have a Taylor rule. We don't have a dollar standard. We have no rules at all. Our central bank is just making it up as they go along. I want to talk about economics a little bit and start by quoting one of my favorite authors, F. Scott Fitzgerald. And in 1936, F. Scott Fitzgerald said, "The test of a first-rate intelligence is the ability to hold two opposed ideas in mind at the same time and still retain the ability to function." In other words, can you entertain a contradiction and process that without becoming completely dysfunctional? And I think I call this Fitzgeraldonomics. I think it's a very good guide to understanding the international monetary system today. And here are the two opposed ideas. People argue about inflation or deflation, which one is prevailing, which one is a threat. And I'd like to suggest that we are experiencing inflation and deflation at the same time, underlying the economy. That deflation is the natural consequence of a depression. I would say that we are not in a normal business cycle, where you go down and then they ease and then we go up again and then they tighten and we go down and we go up. That's a normal business cycle, a normal credit cycle, normal recession and expansion. That is not what the world is going through today. What the world is going through today is a depression. A depression is different. A depression does not mean that economic growth declines all the time. Some people think that's what it means. That's not what it means. What it means is that you can have some growth in a depression, but the growth does not get back to trend. It's not your potential growth. It's significantly lower than your potential growth. And over time, if you draw a line of potential growth and draw a line of actual growth, that gap gets larger and it cannot be recovered. That's lost wealth. That's what a depression is. That's what John Maynard Keynes defined it as, a long continual period of below trend growth. That's what we're in. And the problem is that because it's not a business cycle, the problems are structural. You need structural solutions. You cannot solve a structural problem with a cyclical liquidity solution. To solve a structural problem, you need a structural solution. And so all the central banks are responding with cyclical solutions to a structural problem. That's why it won't be fixed. That's why this depression will continue. So in a depression, what do people do? They deleverage, they sell assets, they pay down debt, they reduce their balance sheet. Selling assets pushes prices down more. More people get in distress. They sell assets. That cycle feeds on itself. This is the debt deflation cycle of depression, first outlined by Irving Fisher in the 1930s, and it's something that central banks very much fear. So that's the deflationary vector. The inflationary vector is caused by money printing, by central bank policy. And so what you have are two forces that are offsetting each other. And it's almost like tectonic plates. If you study seismology, you can go stand on a fault line. I've gone out to California and stood right on the San Andreas Fault. You can see it because it's a desert and it's green because the water bubbles up. So I've stood on the San Andreas Fault and it wasn't moving. But we know it's unstable. Underneath, there are extremely powerful forces pushing against each other. And I want to suggest that we have a very powerful deflationary vector and a very powerful inflationary vector. And if you have 5% deflation and 5% inflation, the net is zero. So it looks like things aren't moving. It looks like price stability, but I want to suggest it's actually highly dynamically unstable, and there's a danger that it could tip into deflation or much higher inflation very quickly. And so what investors need to know is that you need to be nimble, you need to be prepared for either one of those outcomes because either one is possible. I want to digress just a minute into what's called the quantity theory of money, advanced originally by Irving Fisher, later by Milton Friedman, and I think Milton Friedman is most closely associated with this. And it's an equation, and it's a very simple equation. The classical expression is MV equals PQ, M times V equals P times Q. The M is money supply, just how much money is in the system. The V stands for velocity. Velocity is the turnover of money, so how quickly is the money turning over. So if I go to dinner tonight and I leave a tip for the waiter, and the waiter takes the tip and he takes a taxi cab home, and the taxi driver takes the fare and buys gasoline for his taxi, that money has velocity of 3. In other words, $1 or 1 euro supported 3 euros of goods and services. So that would have velocity of 3. But if I stay home and watch television and leave my money in the bank, that has velocity of 0. So velocity is just the turnover. So how much money is there? How quickly is it turning over? And that equals the gross value, gross nominal value of goods and services in the economy, which has 2 parts, P and Q. The Q is real, that's real growth, and P is the price index, which can be inflation or deflation. So Milton Friedman looked at this and he said, well, this is a trivial problem. We know that Q can only be at most about 3.5% a year in a mature economy like the United States. So leave aside developing economies. In a mature economy like the United States, the most you can grow without inflation is increase in labor force plus increase in productivity. How many people are working? How productive are they? That's all there is. So in the US, the labor force grows about 1.5% a year, and productivity grows about 2% a year. So you add them together, maximum growth in the United States is about 3.5%. Now, there are leads and lags, and sometimes it's higher, sometimes it's lower, but in general, the central tendency is 3.5%. And Friedman said, well, we want P to be 1. 1 means no inflation, no deflation, because any number times 1 is itself. And so if you want no inflation, P is 1, so Q times 1 is Q. So Q can only grow 3.5%. P we want to be 1. Friedman assumed that velocity was constant. So he said this is a trivial problem. All you have to do is increase the money supply about 3.5% a year, and you'll get maximum real growth with no inflation. And that's central bank nirvana. And Friedman used to joke that we don't need central banks, we just need a computer to crank out money supply about 3.5% a year, and we'll have maximum real growth, no inflation. That was Friedman's theory. So let's test this in the real world. So what's going on with money supply? This is U.S. money supply, base money created by the Federal Reserve. Well, you see that from 1980 to about 2008, money supply grew about the way Friedman would have wanted, a slow, steady increase. And then money supply takes off, goes vertical. This is QE1 in 2008. Then QE1 was stopped, and then in the fall of 2010, we had QE2. This is the second spike up. QE2 was over in June 2011. And then money supply went sideways again, and then in September 2012, the Fed began QE3, and that's the third spike up. And if I came back a year from now, I'd have to update the chart, and it would be up to the ceiling because the Fed is printing about $1 trillion a year. So here you see QE1, QE2, and QE3. So according to Friedman, if you increase the money supply 300%, you should have 3.5% real growth and 296% inflation. So where's the inflation? We don't have the inflation. What's wrong with Friedman's theory? Well, what's wrong is that velocity is not constant. You go back to this equation. Friedman assumed that velocity is constant, but velocity is not constant. Velocity is collapsing. And you can understand monetary policy as a desperate struggle between increasing money supply and decreasing velocity. And so the Fed has got to increase the money supply as long as velocity is collapsing. If they don't, the real economy will collapse. I remind people that $3 trillion times zero is zero. In other words, if you don't have velocity, you don't have an economy. So the role of central banking today is to bend this curve. They've got to get this velocity curve going up. They can make this whatever they want. They can take money supply up or down very easily. But this they cannot change easily. This is psychological and behavioral. So the Fed and other central banks have to engage in mind control, behavioral modification, really propaganda and lying to people to get all of us to change our behavior. Because right now we don't want to spend money. We want to pay off debt, leave the money in the bank. The Fed's got to make us go out and spend the money. So I like to keep my equations simple so I can understand them. But I've given you two equations. 1 plus 3 equals 4, and 3 plus 1 equals 4. Take the first term to be inflation, and take the second term to be real growth. So 1 plus 3 equals 4 is 1% inflation, 3% real growth, equals 4% nominal growth. This is perfect for central banks. This is what they want. They want 4% nominal growth with low inflation. But they can't get the nominal growth right now. So what the Fed is saying is that they'll take 3 plus 1. In other words, 3% inflation. Sorry, first term is inflation, second term is nominal growth. They'll take 3% inflation plus 1% real growth to get to 4% nominal growth. They've got to get to 4%. They've got to get to 4% nominal growth because the debt is nominal. You can only pay off nominal debt with nominal growth. They would prefer more real growth, but they've given up on real growth. They'll take nominal growth through inflation. So what the Fed is telling you is you should expect more inflation. We're not seeing it yet, but they're going to keep trying. So this will come. What are the tools? I said the Fed needs to get 3% inflation, going back to this, 3% inflation to get to 4% nominal growth. What are the tools for getting to 3% inflation? The first one is negative real rates. A negative real rate is simply a situation where the rate of inflation is higher than the nominal interest rate. So a simple case would be if we have 3% inflation and 2% nominal rates on a 10-year note, that's a real rate of negative 1%. That's a very powerful inducement to borrow. When you have negative real rates, it's cheaper than zero. The bank's actually paying you to borrow the money because you get to pay them back in cheaper dollars. So they're paying you to be a borrower. Very powerful incentive to borrow. The other thing the Fed needs to do is to deliver an inflationary shock. And here's where the propaganda comes in, because the Fed says publicly that their inflation goal is 2%. So 2%, 2%, 2%. Every speech, they say we have a goal of 2%. But if I promise you 2% and I give you 2%, there's no change in behavior. I've exactly met your expectations. You had already set your expectations of what I told you. What I have to do is lie to you. I have to promise you 2% and give you 3%. Then that comes as a shock. It's a behavioral shock. You say, oh my goodness, inflation's out of control, I better buy a house, buy a car, etc. So the Fed's goal is to get to 3% inflation and keep nominal rates at 2% through financial repression. If they can do this, they will accomplish two things. They will make it very cheap to borrow, very attractive to be a borrower, and they will make people want to spend because they're worried about inflation. And the idea is to get the lending and spending machine going again, increase nominal GDP, get nominal GDP back to trend, make it self-sustaining, then withdraw policy, substitute real GDP for nominal GDP, get real GDP back to trend, and we all live happily ever after. This is the Fed's goal. They will fail at this, but they think they won't, and this is what they're trying to do. So here is what failure looks like. This is the Fed's worst nightmare. Again, a very simple equation. So take nominal growth, subtract inflation, and that equals real growth. So, and the way this is normally expressed, you might see something like 5% nominal growth minus 2% inflation equals 3% real growth. So 5 minus 2 equals 3. That's a normal way of thinking about it. But in a world of deflation, you have to use negative numbers. So imagine a world where nominal growth is actually -1, where it's actually going down. But inflation is deflation, which means inflation would be expressed as -3. So now nominal growth minus inflation is -1 minus -3, which means you have to add the absolute value of 3 equals 2, +2. So in this equation, you have 2% real growth. 2% real growth is attractive. It's not too bad. But nominal growth is going down. The only reason you have real growth is because prices are falling faster than nominal growth. But nominal growth is going down. What does that do to your tax collections? It destroys them. What does it do to your debt to GDP ratio? It goes up. So here's a world where you have real growth, but your tax collections are imploding, your deficits are increasing, your debt to GDP ratio is going up. This is what we are in danger pardon me, of experiencing in the United States. Japan has already experienced something like this. So this is the Fed's worst nightmare. This is why they must have inflation. They are not neutral as between deflation and inflation in terms of changes in the price index. Policy has to be asymmetric. They have to have inflation because deflation is so destructive, not to everyday citizens. I like it when prices go down personally, but it's destructive to government finance and central banks. How is the Fed going to achieve 3% inflation? Well, they've tried everything. In 2007, they started cutting interest rates. In 2008, they began quantitative easing. In 2008, they also started communications policy. They call it forward guidance. I call it propaganda. In 2010, they started the currency wars. In 2011, Operation Twist. In 2012, they announced nominal GDP targets in effect. They said, we will not raise interest rates before unemployment gets to 6.5% and inflation gets to 2.5%. Those are thresholds, not triggers, so they may actually go past that. What's next? 2014, I think we should expect helicopter money. Helicopter money, you know, the notion is you throw money out of helicopters and people just spend it. That's a bit of a metaphor. The way you actually do it is you enact a tax cut and then you finance the tax cut with money printing. So you say, the Fed says to the Treasury, go ahead and cut taxes That'll put money in people's hands. They'll go out and spend it, and to the extent your deficit goes up, we will print the money to buy the bonds. That's what helicopter money is. It's a Fed-financed tax cut. The idea is to bypass the banking system. The problem today is, you go back to this, the Fed prints all that money, but the money stays in the banks. The banks are not lending it and people are not borrowing it. So with helicopter money, what you're doing is you're bypassing the banking system. You're handing people the money through the tax cut and then printing the money to buy the bonds. So that's the background of what the Fed is doing. That's the background of the currency wars. That's the background for monetary policy. I like to say it's very easy to forecast monetary policy. People think forecasting is difficult, and I say forecasting is easy. What's difficult is getting the model right. If you get the model right, then the forecasting part is easy. And the model is that the Fed has to get to 3% inflation. And if you want something and you're not getting it, what do? Try harder. So they'll just keep printing money. And so my question is, as an analyst, what could go wrong with this policy? The Fed is making a number of mistakes. The Fed actually doesn't know what they're doing. Everything I just described, I'm trying to explain what the Fed is doing, but as an analyst, I'm going to tell you that they don't understand how the economic system actually works. They're using the wrong models. And the Fed, first of all, doesn't appreciate dynamic modeling. They would look at this car, look at this automobile, and they would say, there's nothing wrong with that car. It's shiny, it's got 4 tires, the engine works fine, full tank of gas, nice oil change. The car's perfect. But we all know what's going to happen next. The car is going to crash, there'll be an explosion, and people will be killed, and there will be a disastrous outcome. So the Fed, one of the Fed's problems is they're looking at more or less static models and not using proper dynamic models. I like to say that the Fed thinks that they're playing with a thermostat. You know, a thermostat is a linear, reversible process. So if the house is too cold, they dial it up. If the house is too warm, they dial it down. It's linear, reversible, as I said. In fact, the Fed is playing with a nuclear reactor. A nuclear reactor is a critical state dynamic. It's a complex system, not a linear system. You can dial a nuclear reactor up or down, but you better get it right, because if you get it wrong, you will have a catastrophic meltdown. And there's no such thing as a melt up. A meltdown is irreversible. And the problem, the Fed thinks they're playing with a thermostat. They're actually playing with a nuclear reactor. They risk creating a critical state, out of control, chain reaction that collapses confidence in the US dollar. And this is my major concern, is that they misapprehend the statistical properties of risk. I want to spend just a minute and ask a question, because it's a very important question. Are capital markets complex systems? Because if capital markets are complex systems, that means we can use complexity theory. It's a relatively new science. It's about 60 years old. But a lot of work has been done in complexity theory in climatology, seismology, and other branches of science. Oh, thank you. Thank you very much. Not much work has been done in applying complexity theory to finance. But if capital markets are complex systems, we can import a lot of complexity theory and use it to understand capital markets. This is what I've done. This is what some others have done. Had very good results with this. There are 4 hallmarks of a complex system. If you're trying to figure out if something is a complex system, ask yourself 4 questions. The agents, the autonomous agents in the system, so that's all of us, are they diverse? If everyone thinks the same thing, that's not a diverse system and it's not complex. But in capital markets, of course, we have bulls and bears, fear and greed, speculation and hedging, longs and shorts. I think we have ample diversity. I think that's very clear. The second thing is connectedness. If people have different points of view, it doesn't do any good unless they're connected in some way. If we're sitting in 50 different houses and we all think different things, but we're not connected to each other, that's not a complex system. So you need the connectedness. Again, I think that's an easy test to pass. You look at Bloomberg and Dow Jones and Reuters and email and CNBC and BBC and television, iChat, on and on and on. We're probably over-connected, but that's an easy one. The third thing is interaction. So we have different points of view. We're connected. Are we interacting? Well, of course. Trillions of euros of transactions every day in stock markets, bond markets, foreign exchange markets, etc. And the last criteria is adaptability, which simply means, does our behavior change in response to other people's behavior? Well, again, that's an easy one. I manage a hedge fund. When you lose money, that's the market's way of telling you better change your behavior very quickly. And I analogize it. You're in you're in your apartment and you want to go outside and you're not sure what the temperature is. You don't know what to wear. And you look out the window, and everyone has down jackets and hats and gloves. You're probably not going to go outside in a short sleeve shirt. You're going to put a heavy jacket on. In other words, you're going to use that information to adapt your own behavior. So I think these four criteria are very easily satisfied in capital markets. If that's the case, then capital markets are critical systems. I think there's very little doubt about that. I want to take you through a graphical representation. This was prepared by the London School of Economics, and it's a density function in a complex system. And what they did, and I apologize for the fact that the dots are a little bit hard to read, but I put these big dots in just to show. They took 5 sectors. Light green is finance, blue is technology, dark green is real estate and mortgage finance, black is energy, and white is basic materials. So those were the 5 sectors. They took 500 enterprises, large enterprises, in those sectors, and those large enterprises are the dots. And they identified connections between them. It could be cross-ownership, a financial transaction, interlocking directorates, any connections between them. This is not drawn by hand, obviously. You pick your data set, you load the data in, there's software that will produce this graphical representation. So they got all these 500 companies, found the connections, identified the criteria, loaded the data, boom, push a button, here's what came out. Now, here's the point. This is a sequence from 2003 to 2008. You can see in 2003, the sectors are distinct. Of course, there are connections between them. One would expect that. But most of the connections are within the sectors rather than across the sectors. So it looks like a spider or an octopus. You can see 5 distinct sectors. Now look at what's happening between 2003 and 2008. 2 things are happening. First of all, the density is increasing. The interconnectedness of the sectors is increasing so that more and more it looks like one blob. The sectors are losing their distinctness, and the entire system is becoming one highly dense, interconnected network. That's number one. Number 2, finance is at the center of it. The entire economy is being sucked in to a financial center and being financialized. By 2006, mortgage finance disappears. It's been completely subsumed into Wall Street finance, in other words, Lehman Brothers type enterprises. So by 2008, you don't have 5 distinct sectors anymore, you have a blob. Now here's my point. The minutes of the Federal Open Market Committee in 2008, just before the crisis reached an acute stage, quote, Ben Bernanke is saying, this will blow over. Those were his exact words. His assessment of the financial stress is that it'll blow over, we'll get through this. I want to suggest that a graduate student, a bright graduate student in complexity theory, with no knowledge of finance whatsoever, didn't know anything about finance, who was given this data and shown this, would say in 2008, your system is on the verge of collapse. You're going to collapse because you're so tightly interconnected. Your density function is so great that one small problem in any part of the system will very quickly propagate through the system as a whole and collapse the entire economy. Now, why would the graduate student be correct and the chairman of the Federal Reserve be wrong? And the answer is because he had the right model. He understood what we're looking at here. So I want to suggest that using complexity theory, density functions, and this kind of representation, this way of thinking about things, is a more powerful tool to understanding risk than conventional stochastic general equilibrium models that most central bankers use. And here's one that's actually produced by the IMF. Now here, These are just financial interconnections. So this is insurance sector, banking sector, non-bank financial entities. You see a density function. At the middle, you see JPM is JP Morgan, BAC is Bank of America Corporation. I apologize for the fact you can't read all those names. They're a little too small, but they're all our friends, you know, Citibank and Goldman Sachs, some of the big red dots, and then a lot of smaller international banks around the perimeter. You can see how densely connected this is. Now, one thing I have to warn you about, the IMF did this on a net basis, used net exposure. That's not the right way to think about financial risk. You should think about financial risk on a gross basis. If you did this on a gross basis, the whole thing would be black. In other words, the density function would be so great you wouldn't be able to distinguish it. So this tells us, and just empirically, in 2008, what did we hear about? We heard about banks that were too big to fail. Well, guess what? 5 years later, in 2013, the 5 too big to fail banks are bigger. They have a larger percentage of the total assets in the financial system. Their derivatives books are larger. If you did this graphical representation, the density function is greater. In other words, everything that was dangerous in 2008 is worse today. We've made no improvement at all. We have a riskier system. What's happened is that through government intervention and federal and central bank money printing, they've been able to restore some level of confidence. But empirically, analytically, the system is more dangerous, more vulnerable, closer to collapse than it was in 2008 when the panic began, which is why I find it very straightforward to say that we will have another collapse, another financial panic, worse than 2008, sooner than later, because none of the problems have been solved. So let's look into the future a little bit. When this collapse happens, what will the new system be like? I expect the collapse of the international monetary system sometime in the next several years. When I say that, it's not meant to be a provocative statement. The international monetary system actually has collapsed 3 times in the past 100 years. 1914, 1939, and 1971. So it does happen every 25 or 30 years. I'm not saying it's an automatic, clockwork function. I'm just saying it's not highly unusual. When it happens, it's not the end of the world. It does not mean we all go live in caves and eat canned goods. What it means is that for a period of time, there's a muddling through process. There's chaos in the monetary system. And then the major economic and trading powers sit down and they rewrite what are called the rules of the game. They devise a new financial system, as happened at Bretton Woods in 1944, as happened at the Genoa Conference in 1922, etc. So, in the Plaza Accord and the Louvre Accord in 1985 and 1987. So, when this collapse happens, and then the major powers sit down to devise a new system, what will that new system look like? And I've laid out 4 possible paths. A world of multiple reserve currencies, a world of SDRs. The SDR is the special drawing right. It's a kind of money printed by the IMF. A possible gold standard, and a generalized collapse. In other words, things get very chaotic and out of control. The world of multiple reserve currencies, I won't spend a lot of time on this. The idea is simple. In 2000, the US dollar comprised 70% of world reserves. 70% of all the reserve assets in the world were in US dollars. Today, that number is 60%. So the dollar has dropped from 70% to 60%. Imagine that drop continues and the dollar is 45% or 40%, and the euro comes up, and Australian dollars and Canadian dollars come up, and we have this world of multiple reserve currencies where there's no one dominant currency, you have a bunch of them. I call this the kumbaya solution. This is not a solution. In my view, this is unstable. Instead of one central bank behaving badly, you'll have 5 or 6 central banks behaving badly. We're already seeing evidence of that. This does not mitigate the currency wars. It actually exacerbates the currency wars because there is no standard. There is no anchor. There is no gold. There is no dollar. There is no Taylor rule. There's no anchor to the system. So I view this as highly unstable, just making the problems worse. Global monetary elites, and when I say elites, I don't mean a deep, dark conspiracy. I'm talking about finance ministers, academics, IMF officials, and others, want a world of SDRs. The SDR, a lot of people don't understand it. A lot of international economists don't understand it. It's very simple. The Federal Reserve has a printing press. They can print dollars. The ECB has a printing press. They can print euros. The IMF has a printing press also. They can print SDRs and they can hand them out. So it's just another kind of fiat currency. The next time there's a crisis, it will be bigger than the Federal Reserve. In 2008, our central bank, the Federal Reserve, reliquefied the world with trillions of dollars, not just of money printing, but swap lines, swapping dollars for euros with the European Central Bank, so the ECB could lend dollars to European banks that had dollar liabilities to U.S. money market funds. I mean, the amount of, this was in the tens of trillions of dollars that were printed or loaned or swapped or guaranteed by the Federal Reserve. That got us through this. The next time there's a crisis, it will be bigger than the Federal Reserve, because if you go back to this slide, okay, the Federal Reserve has printed $3 trillion without a crisis. We haven't had a liquidity crisis since 2008. If they print $3 trillion without a crisis, what are they going to do when there is a crisis? Print $6 trillion? $9 trillion? I mean, there's a limit. The Fed is at the outer limit of what they can do. So the next time there's a crisis, it will be bigger than the Federal Reserve. There's only one clean balance sheet left in the world. That's the IMF, because the other central banks have done the same thing. Bank of England, Bank of Japan, the ECB to a lesser extent, but all the central banks have used up their money printing capacity to a great extent. They won't be able to do it again. The IMF is the only clean balance sheet. They will have to print the SDRs and hand them out. That will reliquify the system. In theory, it will also be highly inflationary. So this is the coming thing. You should watch this very carefully. I'll skip these two slides. The third thing is a gold standard. There's no central bank in the world that wants a gold standard, but they may be forced to go to a gold standard to restore confidence. It's not something they want, but it's something they may have to do. A lot of people who talk about a gold standard, they say, you know, we have to have a gold standard, and they bang the table. And you say, well, what do you mean by that? And they don't actually know. Every gold standard is some relationship between paper money and gold. I mean, some people think we'll walk around with gold coins. We're not going to walk around with gold coins, but you can have a paper dollar or paper euro that is backed by gold, that represents gold. It's in effect a warehouse receipt. Well, you have to ask yourself a couple questions when you design that system. The first question is, what is my definition of money? Because as you know, there's M0, M1, M2. These are all different definitions of money, so you have to choose one of them. Number two, how much gold backing do you need? Now, a lot of Austrian economists would say it has to be 100%, you know, because we don't trust governments. Maybe. But historically, that has not been true. Historically, the Bank of England had a gold standard in the 19th century with 20% backing. For most of the 20th century, the U.S. had a gold standard with 40% backing. So historically, you can have between 20 and 40%. Maybe it has to be 50%. But all you really need is enough gold to stand up to the market. The third thing you have to decide is which countries will be included. This will almost certainly be international. The U.S. could do it on its own, but that would be a blunder, because if the U.S. had a gold-backed dollar, it would be the only currency anybody wanted, so all the other currencies would have less value, which would be deflationary. That would repeat the blunder of the 1920s. So let's assume it's maybe M1, maybe 40% backing, all the major countries are included. I think that's a reasonable set of assumptions. How much gold is in the system? Well, the 17 members of the European monetary system together, including the Slovak Republic, have 10,000 tons of gold. The United States by itself has about 8,000 tons. The IMF has almost 3,000 tons. China officially says they have 1,000 tons. Of course, unofficially, they have a much higher number, probably 2 or 3, maybe 4,000 tons. Then you see Switzerland and Russia. Russia, I have to update this, they've recently gone over 1,000 tons, but you can see where the gold is held. if you take global M1, so here I've done the US ECB and China, take the combined M1, as I call that GM1, with 40% backing, that's the first bar. The implied non-deflationary price of gold is almost $7,000 per ounce. That's not a number I made up, it's just, this is all publicly available data, it's 8th grade math. Just take the money supply divided by the gold, and this is the implied price. If you have a lower price of gold, you could do that, but it's deflationary. It means you have to reduce the money supply to be able to make a market at this level. So that, again, that would be repeating Churchill's mistake of 1925. So if you take global M2 with 100% backing, that's $44,000 an ounce. Now, I'm not predicting $44,000 gold. Don't tell people Jim Rickards says gold's going to $44,000. I think that's unnecessary. But I do think it's going to $7,000 or $8,000 an ounce in a world where you have to return to a gold standard to restore confidence. And the fourth outcome is collapse. I think this is actually the most likely because central banks don't understand risk, as I've described, through wishful thinking, denial, delay, misapprehension of the statistical properties of risk. We will stumble into a crisis. It will spin out of control. Governments will probably respond with executive orders and even a sort of neo-fascist response. So that's one outcome. That's my book. I hope you have the opportunity to read it, and I thank you very much. We have time for questions. I'll put my earphones on. Bear with me 1 second, please. Okay, are there any questions? Yes, sir, in the back.
May I ask? I have two questions. Okay, thank you. I have two questions. The first question is regarding your main point of the presentation, and that is that central banks don't understand unlinear models. Are you so sure about it? Because my point of view is that since the global financial crisis, I do not think that central banks were not aware of unlinear models, because all of their steps they make were not the same as in the past, because they started quantitative easing, they tried they tried all of the reactions, and most of the reactions were new. So I do not think they are trying to repeat some historical or some historical exercise. They are trying to find a new way how to solve find the solution. This is not the way that I agree with all of the steps they did in the past. I just want to ask how we are sure, if you are so sure that they do not understand the unlinear models, because they are also the people who are learning from the mistakes. And the second question is, if you feel that in the past, I know 5 years ago, if there were some other solution they could do, and the world would be a better place right now. Because once again, there is a lot of criticism of the central banks, but sometimes I'm missing the steps we should be done in the past, that we should be in a better place. Thank you.
Right, thank you. Well, in terms of policy, you're right that they are pursuing new solutions, but they're still using the old models. In other words, their models are telling them that, they look primarily at the 1930s, and they say the mistake of the central bank in the 1930s was they did not expand the money supply enough, and that contributed to the Great Depression. So today, facing depressionary conditions, you would increase the money supply drastically. So it is a different solution, but it is not a different model. So what they're missing is that by increasing the money supply, propping up the banks, increasing derivatives books in the banks, they're creating enormous systemic risk which will collapse in ways that they don't understand. So I agree with you that they're pursuing new policies, but the new policies are based on the same flawed models. I talked to Federal Reserve Bank presidents, I talked to head of monetary research at the Federal Reserve. I've spoken to a number of current and former governors, and I have the same discussion I've had with the group today. And they can't, when you talk about complexity theory, they can't even process it. In other words, it's not that they disagree, because I always invite a debate. I'm very happy to have debates. They can't even understand what you're saying. So I agree with you that they're doing new policies, but they're still basing it on the old models, and the old models do not correspond to reality, and that's the problem. That's why we're not getting the growth. Now, your second question is, okay, fine, you want to be a critic of the central banks, go back to 2008, what would you have done differently? How could you have got a better outcome? The answer is that I think QE1 was a proper liquidity response to a liquidity crisis. That was probably consistent with the role of a central bank. Except the classic definition of a central bank, or the role of a central bank, Walter Bagehot in the 19th century said that in a panic, in a crisis, a central bank should lend freely against good collateral to solvent banks. In other words, you're solvent, but you're temporarily illiquid, so I'll give you the liquidity you need for a pledge of good assets. But 3 parts: lend freely, good collateral, solvent banks. The Fed followed one of the 3 parts. They did lend freely, but they did not get good collateral in every case, and the banks were definitely not solvent, most of them. So what should they have done? The United States should have nationalized most of its banks. They were all going to fail. Instead of bailing them out, they should have been shut down. Stockholders should have been wiped out. Bondholders should have taken haircuts, 20, 30, 40%. Management should have been fired. Many of them should have been put in jail after due process of law. And then strip the bad assets out of the bank balance sheets, put them under a rock in a 20-year trust for the citizens, then take the remaining clean bank, now with all the bad assets gone and a new capital structure, IPO it, because you don't want the government to own the banks permanently. It would be a temporary solution. IPO them, and now you have clean private banks that can actually make loans, number one. Number two, beyond QE1, there should have been no QE2, QE3. The Fed should have raised interest rates to reward depositors and savers and sort of convert from a consumption-driven economy to an investment-driven economy. In the 1950s and early 1960s, consumption was about 60%, 60, of US GDP. Today that number, and recently that number, has been 70%. So we are unbalanced in the same way that China is unbalanced. China has gone way too far to investment, most of it malinvestment in classic Austrian economic terms. The US has gone way too far to consumption. We have to rebalance to have a more investment-driven economy. So shut down the banks, higher interest rates, much more punitive solutions. In 2009, that solution would have produced a much worse outcome. We would have had a sharper depression, a sharper decline, higher unemployment, a lower stock market, more bankruptcies. It would have been much worse in 2009, but it would be much better today. In other words, we would have suffered the pain, and we would be on a path to very robust growth of 4, 5, 6%. That's the classic V pattern. You go all the way down, and then you hit bottom, markets clear, and then you go back up again very robustly. That's not what happened. We started going down, but the V was truncated by policy, and now it's flat. But you don't go up again. So the United States today is Japan. We should expect 10 or 20 years of 1 or 2% growth. We're not going to get back to trend growth. We're not going to get back to potential because we have structural problems that have not been addressed. So my solution would have produced a worse, using objective economic data, it would have been worse in 2009, but much better today. Instead, what we've done is we've propped up and preserved all the corrupt banks. Any other questions?
Ja by som navádzal jednu otázku, takú praktickú. Mňa by zaujímal váš názor. Ako to zachovala Čínska národná banka s tým obrovským rezervom, ktorá musí do budúcnosti? Ďakujem.
Unfortunately for China, they've acquired about $3 trillion in reserves. Almost all of that, the vast majority of it, is denominated in U.S. dollars. Most of that is held in U.S. government securities. There's often talk about dumping those securities. You know, they sell them very rapidly, and U.S. interest rates go up, and that hurts the U.S. economy, etc. That I find that very unlikely. They won't do that. You know, the oldest joke in banking, I'm sure you've heard it, you know, if I owe you $1 million, I have a problem, but if I owe you $1 billion, you have a problem. Well, we owe the Chinese $3 trillion, so they have a problem. They're extremely vulnerable to U.S. inflation, so we owe them $3 trillion, but what we'll do is we'll just print $3 trillion and hand it to them and say, good luck buying a loaf of bread. In other words, every 10% devaluation of the dollar relative to the yuan is a $300 billion wealth transfer from China to the United States. But they can't do very much about it. If they start dumping their securities, they'll hurt themselves even more. So what China is doing is they can't dump what they have, but at the margin, as they increase their reserves, they're diversifying into euros. Well, I've been very bullish on the euro for years. Everyone was trashing the euro. I was like, no, the euro's going to get stronger. But part of why the euro will get stronger is because Chinese capital flow now wants to come to Europe. China did not want to bail out Europe 3 years ago. You know, in 2010, they weren't going to buy Greek bonds because they didn't want to be suckers. They wanted to see Europe get its act together, make structural changes. Now that Europe has made structural changes, the Chinese are willing to come in. So at the margin, they'll be buying more euros. But the other thing they're doing is buying massive amounts of gold. Now, every way they can. They're buying mines, they're buying gold output from refineries, etc. Now, when you have a lot of gold and you have a lot of paper, in effect you have a hedge. Because if the U.S. inflates the dollar and devalues the value of the dollar in real terms, the Chinese will lose on the paper side, but they will gain on the gold side because obviously gold will go up in inflation. So China can get to the point where if they have enough gold, to some extent, that will hedge the dollar exposure. So if we inflate the dollar and the dollar goes down, the gold will go up. At that point, they're in a neutral position. So what they're really trying to do, they can't dump the dollars, but they're trying to hedge the dollars with gold. Have any other questions? Happy to.
Okay. Chcel by som sa opýtať, či je tam v tejto situácii nejaká šanca, že sa dostaneme k nejakej jednej svetovej mene, ako ste spomínali už SDR. A druhá otázka by bola, v poslednej dobe zažilo zlato dosť veľkú nejakú stratu alebo pullback. Čo si myslíte, že bolo príčinou a ako vidíte ďalší vývoj? Ďakujem.
Thank you. I think there's a very strong possibility of a world currency, a global currency, the SDR, as I mentioned. Now, just to be clear, we will not have SDRs in our pockets. You know, you'll have euros, I'll have dollars. The SDR will not be a local currency. It'll be a world currency for a small set of very big, important things. So the price of oil will be in SDRs. The financial accounts of the several hundred largest corporations in the world, so Volkswagen or Siemens or SAP or IBM or General Electric, these companies will state their financial statements in SDRs. Balance of payments between countries will be denominated in SDRs. But this will be a problem for the United States because if the United States owes SDRs to another country, we can't print them. The IMF can print them, but we can't. So we'll have to earn them. We'll be like, if a European country, if Slovak Republic wants dollars to buy U.S. imports, you have to earn the dollars. You have to have a trade surplus or to attract direct foreign investment. You have to do something productive or attractive to get the dollars. Well, the United States suddenly will find that it can't just send dollars around the world. It has to be productive and earn the SDRs. beyond the extent to which, I mean, everybody will get some because the IMF will print them and hand them out. But once that happens, and that'll be highly inflationary in and of itself, from then forward, you will have to earn your SDRs, and the U.S. will be like any other country. We won't be able to just print the money to pay our bills. So yes, I do envision something like that. The IMF thinks this is something that will happen over 10 or 15 years. But I'm making the point that it may be much sooner than that, because if there's a crisis, they won't have the luxury of waiting 10 years. They won't be able to wait 10 years. They'll have to respond immediately. And if they are in a position where they have to print 4 trillion SDRs to re-liquefy the world, then you very quickly have to move to the infrastructure, the SDR bonds and dealers and repo and hedging and futures and all the things you need to have a reserve asset. So the IMF may have a 10 to 15 year plan, but I'm suggesting that it may be accelerated, not because they want to, but because that would be the emergency response to a crisis. So I do see something like that. It may fail for other reasons, but I do see something like that happening. With regard to the price of gold, there were a combination of fundamental and technical factors. The fundamental factor is that the worst environment for gold is steeply positive real rates. It's not so much the level of interest rates or the level of inflation, it's the relationship between interest rates and inflation. So if nominal rates are higher than inflation, that's a positive real rate. If inflation is higher than the nominal rate, that's a negative real rate. Gold loves negative real rates. That's the best environment for gold, because the objection to gold is that it has no return. Well, in a world of negative real rates, money has no return either. It's actually negative. What happened was, as U.S. inflation kept coming down, U.S. interest rates kept coming up, particularly after May. I know there was a big crash in April, but particularly after May, with the talk of tapering, U.S. interest rates went up. U.S. interest rates went steeply positive. So that's a very bad environment for gold. There were also technical factors. A lot of gold was held by what are called weak hands. Weak hands are people who are either leveraged, so they have to worry about margin calls, or they do not have permanent capital, so they have to worry about redemptions. Or they're on a mark-to-market system where if they go down, they have to tell everybody what happened. So the strong hands, the people who don't care about those things, the strong hands are central banks and actually individuals. If you buy gold and you don't use borrowed money and you just put your gold in a safe place, in a way you don't care. I mean, gold can go like this, but you can just hang on to your gold. But if you're a hedge fund and you own gold and it goes down and you report the loss and your investors say, we want our money back, what do you have to do? You have to sell more to get the cash. That drives the price lower. Then you get more redemptions. You have to sell more. So you're in a feedback loop, or even a death spiral. So John Paulson had the most famous hedge fund. Gold was an asset that went up 12 years in a row, and Paulson managed to lose $3 billion. That's not easy to do, but that's what happened. So you had technical reasons for it going down because of positive real rates, and then you had weak hands who, for the reasons I mentioned, were forced sellers. And then probably some hedge funds that were conducted a bear raid where, you know, if I'm a hedge fund, I'm not involved in gold, but I see these other hedge funds are involved in gold. I could just start selling futures, you know, selling paper gold and forcing you to have more losses. So manipulation, fundamental factors having to do with interest rates, technical factors having to do with weak hands. So that, I think, accounts for the reverse. And once it starts, it feeds on itself. You know, April 13th, 2013, gold went down about 5%. Well, that Monday, April 16th, it went down 10% in a single day. That's an example of it feeding on itself. Now, the other side of that is that the strong hands are buying. Russia, China, and a lot of individuals around the world. When gold went down almost to $1,200 an ounce, individual citizens lined up all over the world. I mean, there were scenes in Thailand and China and Shanghai and elsewhere, people saying, I want to buy gold. So it found a floor, and that's still true, and the Chinese are still buying. I know that the Chinese bought a lot of gold in July, very close to the lows. The Chinese are really smart. they buy the dips, the same way people trade stock markets. So I think gold went through a very severe test. I think it had the fundamental and technical reasons I described. It found a level. Now it's kind of going back up again, not steeply. I don't think gold will go up sharply in the short run. I think it'll kind of go sideways for a while. I do see the $7,000 price. I absolutely see that coming, but there are going to have to be a set of catalysts for that to happen. Some of the catalysts would be much higher inflation, so that would give you negative real rates. More transparency by the Chinese. If a year from now they announce that they have 5,000 tons, people will say, well, wait a second, why did you spend the last 6 years buying 5,000 tons unless it's extremely valuable? Russia and China want to confront the United States over the dollar. They don't have good reserve currencies, but if they have enough gold, that could form the basis for that. And then you can get a positive feedback loop where it feeds on itself. So there are a set of circumstances that will drive it higher, but not in the short run. I think gold may just kind of go sideways for a little while. Okay, great. This is our last question.
Hi. Did you address the manipulation in the marketplace by, I came in a little late. Did you address the manipulation in the marketplace by Morgan and the Fed Bank, and how that could possibly end and the results of that?
I didn't, but I can do it right now, which is that the evidence for central bank intervention, you can call it intervention, manipulation, it doesn't matter. They're active in the market. The evidence for that is extremely strong, has been through the 1970s, the 1980s, 1990s, so that there's plenty of evidence for that. Now, a lot of people point a finger at JP Morgan. They go, JP Morgan's manipulating the gold market. That's not true. JP Morgan is an agent. They act for other parties. JP Morgan just wants to be a dealer. They want to make a spread. If they're selling futures, it's because they're long something else. They've leased gold or vice versa. So a bank like JP Morgan or Goldman Sachs or HSBC, they're just dealers. They're making spread. They're acting as agents. So the question is, who are the principals? Who are the people behind it? And no doubt the Federal Reserve, the BIS on behalf of a lot of central banks. Here's my view of the central bank view of gold. The Fed knows that gold will go higher. And the reason for that is I did describe at great length why the Fed wants inflation and how they're trying to achieve it. They understand that if they actually get the inflation they want, that gold is going to go higher. They know that. But what's important to them is not whether it goes higher, but whether it's orderly. They don't want what they call a disorderly market. So if gold in small stages goes to 1,500, 1,700, and 2,000, and 2,500 over a period of years, and it's orderly, they're actually okay with that. What they don't want is where it gaps up. Suddenly it goes 2,000, 3,000, it's going up $100 a day. That's when they'll come in and squash it, because that represents a cascade, a near simultaneous loss of confidence, near instantaneous loss of confidence in the dollar. So the Fed's efforts to squash the price of gold are not about keeping it down forever. It's about keeping it orderly. Just because they want that doesn't mean they'll get it. You could have a disorderly market and panic buying, and I think we will see that at some point. Thank you very much.